Good evening, folks. Welcome to this edition of Weekly Wrap. Every weekly wrap, I end up beginning by taking the name of the US president. And I'm absolutely hoping this is the last time I'm going to do that. And I do not have to take that man's name again, right? Hopefully, with the ceasefire, we don't have to take the man's name again. I don't like doing that. But Dhruthi, how did the market react to whatever has been happening?
All right. So I think we've been tracking the markets every week, right? Right at the beginning of the weekly wrap. And I think for the first time in a long time, we actually have good news. So post the ceasefire, we've actually seen some good recovery in the markets. So starting with small cap, which was up almost 6%, and your Nifty 50, which was about 4.5% increment that we saw. And even the sector, so realty actually saw the maximum jump of 11%, followed by automobiles at 8.4, and even the our smart beta indices, right, the factors, all three of them have done well. So Nifty 100 was at the low wall was at 4.2%. We had momentum, which was almost 7%, and quality, which went up by about 3.5% in the last week.
All right. Yeah, so it's nice to see momentum jumping in. It's doing what it's supposed to do.
Yeah.
When markets go up, it goes up more than the market, and that's how it builds its long-term alpha in place. So obviously, markets are happy; they're optimistic, and we're really holding the ceasefire holds. There's every chance that it may fail, but I think one thing we should note is that the two countries have realized that it is important for them to sit and negotiate now. Enough fighting has happened. They've realized each other's strengths and weaknesses, and I think they figured that they need to sit down. It could be a long drawn affair, but eventually I think we will come to some kind of a close. And in between, you will see these ups and downs because the Strait of Hormuz is not really open.
Yeah.
Though everybody expected it to be open, and oil prices fell by 11-12% the moment ceasefire was announced. It has inched up a little again because we know it is still a problem, and ships are not passing through unless they are negotiating with the Iranian military. And we also know that there has been a drone attack on a critical Saudi Arabian oil pipeline, which is called the East-West pipeline, transporting oil to the Red Sea and from which it gets shipped out, and that has got hit. So we are going to see some of this volatility in oil supply resulting in oil prices also moving up and down. And international markets have all reacted similarly, right? Though we've seen some of the markets move up much more than India. For example, Korea and Japan. Korea moved up by 9.3%. Japan moved up by 7.3% in happiness. Okay, and well, the Nifty is only about 4.4% in this whole process. Gold. What happened to gold?
So something interesting over here. So if you look at the last 1 week, the rupee is actually strengthened, right? So the USD actually fell by about 0.5%. And because of this, there's a difference in the gold returns in USD terms as well as INR terms. So gold in INR was up by 0.9%, but in USD terms, it was actually up to 2.4%.
Yeah. So even if we compensate for the appreciation in currency, the change in dollar terms is more than what it should be.
That's right.
So I am wondering, possibly, I don't have an answer, but it could be because that gold pricing in India is now not dictated by what happens in London. So London pricing is different, and India prices its gold based on domestic exchanges. So based on local demand and supply also, it could vary. So yes, we have seen gold demand in India fall from Jan to Feb and Feb to March. Okay, it could be reflected, but it's too early to say. Let us wait till the end of the month, and when we have more data on gold inflows for the month in India, we will know for sure. But yes, the moment the ceasefire was announced, gold should have fallen, but it went up.
Yeah.
So,
and I think that was the case when the war started also, true, right? We expected gold to go up, but it actually went down. So we no longer know, how these commodities will perform during uncertain times. The whole reason we were holding on to these was because we expected this asset class to do well when nothing else would do well.
True. And there is an article in the latest ET Wealth, and Dhirendra Kumar writes, "Who decides the price of your gold?" Okay, so what he is trying to say is much of the price rise in the last couple of years is because of central bank buying large quantums of gold. Correct? We've all been speaking about it. And if central banks decide that enough and they don't buy more gold, gold price won't be going up the same way. And heavens forbid, if they start selling the gold, then we will also see gold price fall.
Yeah.
Okay?
That's right.
So it is not the retail investor that is deciding the price of gold. It is the predominant investor, which is the central bank. The central banks are deciding the price of gold. So, but
So I think what we should actually remember is what Warren Buffett said, right? So he said gold produces nothing, earns nothing, and merely sits there. So keeping this in mind, I think we should definitely allocate 5 to 10% of gold in your portfolio, but we need to look at it as insurance and not as an investment.
Not as a driver of returns.
Yeah.
It should be a means to diversify into a non-correlated asset as an insurance, that if everything else goes wrong, you have something in your portfolio which will do the reverse, meaning do well. So it's become a speculative asset now, and hence we have to be very watchful. That's what Dhirendra Kumar is eventually saying in this article. Let's be cautious about how much we allocate to gold. And at the same time, another article on gold ETFs, the headline says, "Is less metal, more paper the future?" As far as gold ETFs are concerned. So this was all triggered by SEBI allowing gold ETFs to also own futures in gold. And HDFC was the first AMC to make these changes in their key information memorandum and in the documents, and saying that we should be allowed to also own gold futures in our gold ETF. Is it okay?
Yeah, so I think all these days, I mean, it was very different, right? So traditionally, gold ETFs have been backed by physical gold. And now that the regulators are permitting gold futures, it's just not the same. There are a lot of risks involved. So the prices can also deviate between your physical gold and your gold future. So that is one of the risks that we are taking. There may be counterparty risk. But thankfully, HDFC has actually said that even though, I mean, they are one of the first AMCs to say that they will introduce gold futures in their ETF, but they're also saying that they'll only do this in rare circumstances, but they're not able to procure gold or whichever commodity due to scarcity. And this is something that we actually saw sometime last year.
So the gold price and gold futures was very different from the spot price.
Right.
Okay, and when you have demand supply constraints, this could diverge even more. And that's where these risks are, that you're not actually tracking the price of physical gold, but the impact of paper gold will also be felt. A number of American ETFs don't actually own gold.
Right.
They only own gold derivatives. Okay. And if financial markets go for a toss, or if systems and processes go for a toss, we'd be better off holding physical gold, is what I feel. I'm a little conservative and traditional on that. And say, if I want to own gold, I'd rather have a fund that has actual real physical gold in its vaults. Okay. Not that one has to be scared about this, but one should be aware of it and choose whatever you're comfortable with. Right next to this is an article saying HNIs turn to bonds as yields rise. Over the last few months, we have seen yields going up in Indian paper, not only in India, all over the world. Yields have been rising because of a pessimistic view of inflation, ideally, and more borrowing by some of the governments. So in India too, in the last week, we actually pierced 7% and went up to almost 7.1% on the 10-year GSEC, which was quite high. And then after the ceasefire was announced, on the same day, we also had the monetary policy meeting, which held the rates steady. We had yields retreat a bit, and we ended at about 6.9%, 6.95% is what we ended at. Okay, but given that bond yields are much higher than what it was a few months ago, investors are finding some attraction buying high yield bonds, right?
That's right.
So
Yeah.
what are these high yield bonds?
So we're actually seeing a trend where HNIs and ultra HNIs, I mean, they're not moving out of equity, but all the fresh inflows are actually going into high yield bonds, and they're also going into private credit. So high yield bonds, where they're looking at papers that are not, AAA rated. So they have a lower credit rating, but the interest that you're getting on it is a lot higher because of the risk that you're taking. And of course, they're moving towards private credit as well, to enhance their returns, while also taking on lesser risk in comparison with equity.
Yeah, I don't know if it's really lesser risk, because once you have a default, it's capital lost.
Yeah.
At least with equity, you can hope that when the markets go back up, you recover your money. So I still wonder that owning a high risk bond is, you're willing to lose capital. Okay, so you have so many product pushers out there in the market, and we have quite a few alternate investment funds which are pushing high yield bonds. And I have seen indicative bond yields, indicative yields on these AIFs, right from 18-20% in some cases to upwards of 15, some in the 12-13, and some in the 10%. So you have different ranges. You can very easily imagine that those in the 15% plus are very high risk. Okay, and some of those I would not want to touch, okay, unless you're willing to lose your shirt on that. Yeah. So need to be very, very cautious on which high yield bond are you taking. Okay, it can so happen that at times it may be a high yield but backed by a good promoter, and the only reason the yield is high is because the banks are not funding that particular purpose or objective of the promoter. So he comes to the private market to borrow, and he naturally has to pay more for it. And then second, is it secured or unsecured? You have to look at these, and what is the past track record. Ideally, in any of these high yield bonds, I would prefer short duration. I really don't know what's going to happen many years down the line in with a low grade bond. So I'd rather have the maturity come up quick and take your money out. Some of these high yield bonds are not too bad. Okay, as I said, you need to be very careful on looking at it. Better not to take an independent decision. Better to take your decision in conjunction with an advisor who knows fixed income well and is experienced in fixed income. On the same note, since you mentioned private credit, so private credit is unlisted bonds. Okay, and we do have unlisted bonds in India, but the unlisted bonds market in the US has become pretty big. What they call the private credit market has become pretty big, many billions of hundreds of billions of dollars. And why I'm bringing the topic up is the last few weeks have seen the birth of a crisis happening there. Okay, all these private credit bonds are illiquid. So if somebody wants their money back from the fund, it's not easy for the fund manager to sell the bonds and return the money. If it's in small percentages, it's okay. But when say 10% of the investors want their money back, it's a problem. We've seen more than 10, we've seen 20-30% of clients wanting their money back in these private credit funds, all run by large managers. You have the BlackRocks and the Apollos of the world running it, but then if you have an illiquid instrument, then nothing you can do. So they've been getting it. They've been putting limits on how much money a client can redeem from these private credit funds, and the moment you put a limit, it generates more panic. So thankfully, what I believe is much of these private credit or unlisted bonds are owned by institutions and insurance companies only. So it may not trickle down immediately to the retail level. So that way it may be more contained than earlier crises that we have seen. On the monetary policy, we had the RBI meeting on April 8th, and thankfully they've kept the rates steady without any change. I think it was a good decision. Making any change or hiking rates, like ideally a textbook would have recommended. You have inflation nudging higher, and you have an energy crisis, and you have a depreciating currency, should have triggered a central bank action, but the Reserve Bank has preferred to keep everything on hold. And in hindsight, and I think hopefully as we look forward, it would be the right decision, because the moment the Reserve Bank is still free to make changes if the situation worsens, okay, rather than trigger a change now. Because you see, overall inflation has been under control in India. We are under target limit. So why make a change that could that they may have to pull back, or which could cause further damage? So as far as the MPC meeting, it went off well, I think. Yeah. The Reserve Bank has also introduced as a new measure core inflation, and they're also projecting the core inflation. So, what is core inflation? So, core inflation measures price rises excluding food and energy. Okay, so the belief is that food and energy are volatile, and anyway, they cannot be controlled by changes in interest rates. Okay, these are based on demand and supply, and the trickle down effect of these, if it's sustained, would be felt in the rest of the economy. So measuring the price rise without this makes a lot of sense, and there's a lot of demand because much of the world also uses core inflation. Core inflation was at 3.7%, and actually if you remove the impact of precious metals, that is gold and silver, it comes down to only 2.1%. so one can imagine that the Reserve Bank is at the moment not alarmed about inflation. What do you think about this? It says wealthy clients drive PMS multi-asset shift.
Yeah, it's funny. So what the article actually says is you don't need an advisor anymore because you have all of these products that are giving you a mix of different asset classes.
Yes. So it's a quietly it's sort of a misplaced view that is coming out here. The view that is coming out of this article is that if you go to an RIA or a registered investment advisor and pay a fee for the advice that you get, you're not getting a multi-asset model. I think that is a ridiculous way, honestly, ridiculous view, honestly, because if you do go to a financial advisor, you're going to exactly get a diversified view. You're going to get a scientifically constructed portfolio. You're going to get a portfolio which is in tune with your financial plan. If you don't have a financial plan, they'll make a financial plan for you. Okay. And this is completely at odds with what would happen if you actually go to a registered investment advisor. You will get a diversified
Right.
multi-asset view. So I think this article is all bull, and they have to go back and maybe talk to the right advisors, or they're talking to the wrong distributors. I don't know which is what is happening there. Special investment funds, the new kid on the block, right? Early SIF returns are encouraging, but investors must stay cautious. What do you think?
So I think that's sort of what we expected, from these specialized investment funds. So we knew that on the downside, they would be able to, give better returns than the broader market. Of course, because of the long short strategy and the derivatives that are in place. But we'll have to see what happens on the upside. But the performance actually has been great. So the hybrid long short has only fallen by 3.1% in the last month, whereas you have your Nifty 500 that has fallen by 14%, and the balanced advantage fund category average is actually down 8%, and even your flexi cap category average is down 13%. So, I mean, it's done really well.
Yes, yes. And the one equity long short fund, which is the X Top 100, which is entirely equity oriented, that has fallen 10.2%, which is still less than the Nifty 500 of 14%, right? So what is evident is, of course, these funds have not seen a long cycle, and in the short time frame that they have been in existence, what we've seen is a sharp fall in the markets. And we know for sure now how they behave in a sharp fall, and that is good.
Yeah.
They have behaved pretty well. I think they've done better than a balanced advantage fund, which I'm happy with. And even the long short equity has done better than the overall index. So I'm hoping that when markets move up, whenever they do, and they will perform well at that time also. Point is, as the headline says, investors must be cautious because we have not seen these funds in a full cycle. That is, a up and a down, or a down and a up, or an up.
Not enough track record.
Not enough track record. So let us measure this after the next market rise, which I'm hoping will
be very soon,
not be far away. Okay. Then what else do we have? I think this time's ET Wealth was very good. It had a lot of interesting articles.
All right. So we have an article that says elderly loosen your purse strings. Right. So there's a whole generation that actually doesn't know how to spend. And believe it or not, a large segment of the Indian population is also I mean, it's currently in this. I mean, it's a part of this generation, right?
True.
So they're always worried about the future, and they're always saving up for a rainy day, even though they have enough corpus set aside to live a comfortable life. So I think these people need to start spending. They need to really start thinking about their comfort, their happiness, and maybe stop saving so much if you already have a large enough corpus set aside. And another thing is most of their kids are also not relying on them, right? And you also need to allow some space for your indulgences. So
Indulge.
yeah.
So I think there are two issues here. One is cultural, and one is monetary, of course. The cultural aspect is that we have always tended to save and pass on to the next generation. We want to give, we want to leave a legacy for the kids.
Right.
Okay, we don't want to spend it all. We're guilty about spending it all. Okay, we don't realize, or we haven't realized, that the next gen is actually pretty comfortable. They are very confident. They are well educated. They have great futures. They're already earning well. And many of them are possibly earning much more than what this generation that Umasha Srikanth refers to in this article has been earning. So that is a cultural aspect. I think the second aspect, Dhruti, is where people like us can actually play a role is many don't know if they have enough.
That's right.
So they tend to be conservative.
Yeah.
Okay. And whether they have enough is a mathematical calculation, which a good financial planner can do. And they can tell them whether they have more or whether they have less. If they have more, how much more do they have? And so, just as an illustration, if somebody has 10 crores of wealth, and what is enough is 5 crores for living the rest of their lives comfortably based on their current lifestyle, then they can possibly use the other 5 crores to spend more, to indulge more, or give away more. So I think a financial planner can play a very good role in creating a happier life for all these savers. Is it not?
Yeah, definitely.
Yeah.
So maybe you can spend more on your travel, buy some jewelry, whatever it may be.
Absolutely right. Anyway, on that happy note, let's end this weekly wrap. Thank you for listening to us.
Thank you so much.
Have a good weekend.